Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve has executed a complete policy reversal. As of April 4th, 2026, the central bank holds rates at 3.50 to 3.75%, ending a cutting cycle that delivered 175 basis points of relief since September 2024. The higher for longer reality is now market consensus. Core personal consumption, expenditures, inflation sits at 3%, a full 100 basis points above the Fed's 2% target, and showing zero signs of cooperating. Market expectations have collapsed. Early 2026 consensus called for two 25 basis point cuts this year. According to Bloomberg, traders are no longer fully pricing in even a single rate cut in 2026. Futures markets show approximately 80% probability of no change at upcoming meetings, with roughly 48% probability of zero cuts through year-end. Some positioning reflects potential rate hikes if inflation accelerates toward 3.5%, a scenario some economists are modeling if energy and tariff pressures persist. This is one of the sharpest monetary policy expectation reversals in recent years. Jerome Powell emphasized at the March meeting that the Fed sees balanced risks between inflation and labor market deterioration, stating it's not clear one risk dominates the other. Translation: the data dependency doctrine is back in force, and every CPI and PCE print carries outsized market impact. Let's break down what's driving this inflation resilience. Core PCE at 3% is the headline, but the composition matters. Service sector inflation remains elevated across multiple categories. Energy prices spiked due to the Iran conflict, adding commodity pressure to the inflation mix. Tariff effects continue flowing through to consumer prices. According to Charles Schwab analysis, these factors create a sticky inflation environment resistant to previous policy adjustments. The bond market is repricing aggressively. Long-duration Treasuries are under significant selling pressure as yields spike. The iShares 20-plus year Treasury bond ETF, ticker TLT, and the iShares 7 to 10-year Treasury bond ETF, ticker IEF, have faced headwinds as investors dump duration exposure. BlackRock research on Fed rate cuts and portfolio implications highlights the rotation towards shorter duration instruments. The iShares 0 to 3-month Treasury bond ETF, ticker SGOV, is seeing increased flows as investors minimize duration risk. According to ETF database Treasury Yield Snapshots from April 2nd, 2026, there's notable positioning toward the belly of the curve. The iShares 3 to 7-year Treasury bond ETF, ticker IEI, is gaining attention as investors implement laddering strategies. This reflects institutional risk management in a rising rate environment and tactical positioning ahead of FOMC meetings. The equity market is experiencing forced rotation. Growth stocks with high multiples are getting compressed as discount rates climb. Value stocks, which historically outperform in sustained higher rate environments, are attracting capital. Financial sector positioning is particularly interesting. Banks and financial institutions benefit from higher for longer as net interest margins expand when rates stay elevated. This creates a tailwind for financials that wasn't present during the cutting cycle. Goldman Sachs' projections on the outlook for Fed rate cuts in 2026 suggest that when the Fed eventually pivots, the terminal rate could settle around 3 to 3.25% by end year. That's significantly higher than prior expectations and implies limited easing, even if conditions warrant a shift. Labor market data complicates the picture. Employment figures remain robust, supporting the Fed's ability to maintain its hawkish stance without triggering recession concerns. This is the dual mandate tension Powell referenced. Strong labor markets give the Fed room to fight inflation without immediate employment consequences, but also signal demand strength that could sustain price pressures. Energy markets are a critical wildcard. The ongoing Iran conflict has driven crude oil price volatility. As reported by Geo Markets Analysis on oil, inflation, and the FOMC, energy price shocks historically prove challenging for monetary policy management. If crude sustains elevated levels, it feeds directly into headline inflation and indirectly into core measures through transportation and production costs. Cryptocurrency markets are adapting with characteristic volatility. The hawkish Fed stance creates tighter liquidity conditions, forcing rapid risk asset repricing. Crypto traders are hyper-focused on Fed pivot risk, the possibility that sudden monetary policy shifts trigger swift moves across all risk assets, including digital currencies. According to market analysis from MEXC on Goldman Sachs predictions, despite rising oil prices, the higher for longer environment pressures speculative assets dependent on loose monetary conditions. The producer price index is getting increased scrutiny as a forward indicator. Wholesale inflation trends provide early signals of consumer price pressures. Each monthly release now carries market-moving potential as traders parse for evidence of inflation, moderation, or acceleration. Reuters reporting on the Fed, leaving rates unchanged, notes that geopolitical factors are complicating the policy calculus. Supply chain pressures from international tensions, currency market volatility affecting import prices, and global monetary policy coordination challenges create a complex backdrop beyond domestic inflation dynamics. Market positioning reflects preparation for multiple scenarios. Portfolio managers are hedging continued higher rates if inflation persists, while maintaining flexibility for potential pivots if economic conditions deteriorate sharply. Sector rotation strategies are designed to capitalize on the rate environment regardless of direction, with overweights in financials, energy, and value-oriented sectors. According to Yahoo Finance coverage on Powell's inflation impact statements, the Fed may not cut rates at all in 2026. This represents a dramatic shift from just months ago when 2 cuts were baseline expectations. The language from FOMC statements emphasizes data dependency, but the bar for cutting has clearly risen substantially. First Business Bank's quarterly market review for Q1 2026 highlights the repricing across asset classes. Fixed income investors are reassessing duration exposure. Equity investors are rotating sector allocations. Commodity traders are pricing geopolitical risk premiums. The interconnectedness means moves in one asset class rapidly transmit to others. Morningstar analysis on the oil spike impact notes that rate cut expectations are shrinking fast as energy pressures build. The feedback loop between commodity prices, inflation expectations, and Fed policy creates volatility that demands active management rather than passive positioning. The Cleveland Fed's inflation nowcasting models provide real-time estimates of PCE trends between official releases. These tools are gaining attention as traders seek any edge on inflation trajectory between monthly data drops. Current nowcasts suggest core PCE remains stubbornly elevated with limited near-term moderation. Looking at critical decision points ahead, several factors will determine the Fed's next moves. Inflation trajectory is paramount. If core PCE begins credible movement toward 2%, it opens the door for eventual easing. Labor market evolution matters. Signs of cooling in employment growth would shift the dual mandate calculus. Geopolitical developments, particularly resolution or escalation affecting commodity prices, will influence inflation dynamics. Financial stability indicators and credit conditions round out the Fed's monitoring framework. For traders, this environment demands precision. Duration management in fixed income is critical. Sector selection in equities separates performance. Risk asset allocation requires careful calibration to monetary policy expectations. The volatility creates opportunity but punishes complacency. The April 4th reality is clear. The Federal Reserve has shifted to higher for longer. Core inflation at 3% is proving resistant. Market expectations have collapsed from 2 cuts to potentially 0. Bond markets are repricing duration. Equity markets are rotating growth to value. Energy shocks are complicating the inflation fight. Every data release carries outsized importance. BBVA research on the Fed, pausing the rate-cutting cycle, notes that the outlook has improved in some respects, giving the Fed confidence to hold. But improved doesn't mean easy. The central bank is navigating between persistent inflation and the risk of over-tightening into economic weakness. This is a regime change moment. The assumptions that guided positioning through late 2025 and early 2026 no longer apply. Traders who adapt quickly to the higher for longer framework will find opportunities. Those anchored to outdated rate cut expectations will face headwinds. The next FOMC meetings will be critical. April 29th decisions, based on Robinhood prediction markets, show roughly 80% odds of hold. But the statement language, the dot plot updates, and Powell's press conference commentary will drive volatility regardless of the rate decision itself. Watch core PCE monthly prints. Watch producer price index releases. Watch labor market data. Watch energy markets. These are the inputs driving Fed decisions and market pricing. The correlation between these data points and asset class movements has intensified as uncertainty around policy path increases. That wraps your market intel. Trade smart out there. For deeper insights in real-time analysis, visit capitalcopilot.io.